Good evening and welcome to the August 24th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining me this evening. And I must tell you, it has been quite an eventful day. So let's dig right into Office Hours. I want to just share with you quickly the agenda for this evening. I'll tell you just a bit about the Maryland Center for Collegiate Financial Wellness, then a bit about Office Hours, and then we'll jump into questions from our community. A lot of those questions came in today related to the return to repayment for federal student loan borrowers, also broad student loan cancellation, as well as consolidation, and of course, the limited PSLF waiver, which is an ongoing area of interest for many of us. As always, we'll reserve time for Q&A. If a question comes up during the presentation, please do type it in the chat. I'll be checking the chat frequently and also monitoring social media to make sure that we answer all questions that come in tonight. So a bit about the center. The center was created in 2021 with the purpose of helping students and their families build financial life skills and empowering them to thrive. It's not just enough to get by. And we believe that with this vision, all college and career school students in Maryland can achieve these 6 pillars of collegiate financial wellness. Don't worry, I'm not going to read all the text to you, but I just do want to tell you the list of the pillars. And that is becoming creditworthy, ready, resilient, empowered, successful, and thriving. So we've got our work cut out for us, but we're making a difference and happy that you've joined us tonight to be a part of that effort. As for Office Hours is a semi-monthly virtual student loan clinic that's offered for free to provide borrowers, especially Marylanders, with a trusted venue to help them navigate student loan repayment and prepare for success once repayment has finished. Before I get into the questions and answers for this evening, I do have to tell you this disclaimer, and that's that Office Hours is for informational purposes only. This should not be construed as financial or legal advice. It's just information. I strive to obtain the most up-to-date information for everyone from the most reliable sources, but many things have taken place recently, as late as this afternoon, and so it takes time to pine through all of that information and make sure that we're giving the most accurate counsel here. But regardless, the information that you receive tonight is for you to take and combined with other information that you take in from reliable sources, and to consider your personal finances and your student loan situation before you make any decisions. So now that I've got that out of the way, let's jump into the questions. Oh, I'm sorry. Before I jump into the questions, I wanted to share one success story with you from the limited PSLF waiver. We've been talking about the waiver for months since it went into effect in October of 2021. And during last month's Office Hours, I shared with you a success story from a borrower. The borrower had FELF loans and had recently consolidated to obtain public service loan forgiveness. And the first payment count that usually comes for people who have applied for PSLF only looks at the most recent loan. And since this borrower had consolidated, their first qualifying payment count said 2. Now, we all know that 2 is very low when the magic number that we're all trying to get to for public service loan forgiveness is 120. So that number increased as we expected. And the borrower said, I see that now it has been updated to 91 payments that are qualifying. So I only have 29 more payments to make. It says I will receive forgiveness in January of 2025, and I'm still believing that it can happen even sooner. I'm so happy. I thought I was going to have to pay for 10 more years. Well, I just got an update from that borrower within the past week. The borrower's count has been updated, and this borrower has reached 120. As a matter of fact, this particular borrower had more than 150 payments. So by applying for PSLF through the limited waiver and through consolidating those older FELF loans, this borrower, who was looking at much longer than January 2025 before the waiver, is now about to have their debt canceled. They had the picture of the trophies in their account, and in a couple of weeks, we'll check back in for confirmation of the 0 balance within their federal student aid account at studentaid.gov. But I just wanted to share with you the success story and to remind you all that the waiver is working. All right, now let's jump into the questions that came in. This question has been coming in for quite some time. Is our payments resuming August 31st of 2022? And the answer is we got a different date today. The pause on payments is now scheduled to end on December 31st of 2022. So that's an additional 4 months that borrowers have where no payments are required and no interest will accrue on those loans. So this CARES Act forbearance that we've been in since March of 2020 has now been extended to December 31st of 2022. Within that announcement, President Biden said that this would be the final extension. So we're expecting this to wrap up December 31st, 2022, and for borrowers to go back into repayment at some point after January 1st of 2023. In order to prepare for that transition back into repayment, I'm just making some suggestions here for you. The first one is that you update your contact information. You can log into studentaid.gov and make sure that federal student aid has the most up-to-date phone number, email address, and mailing address for you. And you can also do the same thing with your loan servicer to make sure that when payments resume, they're reaching out to you in the best places. The second thing you can do is visit the loan simulator, because after not having to make a payment for more than 2 years, many people are probably not remembering perhaps which repayment plan they are on, whether they need to recertify their income for one of the income-driven plans, or if the repayment plan that they've been on will be feasible once payments resume next year. So you can visit studentaid.gov, log in and try the loan simulator. The loan simulator will allow you to review all the repayment plans that are available, and it can also help you get on track and stay on track for forgiveness through the Public Service Loan Forgiveness Program or through the income-driven repayment plans. So we've got another 4 months. Now, the question that came up a lot today was, how do I know if any of my loans will be canceled? And this question has a lot of layers. So I want to walk through cancellation at each level and talk about how much cancellation is being offered and who will benefit. So let's take a look at broad relief. I know many of you have heard this statistics before, but it's worth repeating that Americans owe a collective balance of more than $1.7 trillion in student loans. And this is about 45 million people that we're speaking of here. So as for who federal student loan cancellation will help, it really depends. For the broad relief effort, it depends on the amount of forgiveness the person receives. And I'll talk about the update that came out from the Biden administration today. But prior to today's update, the numbers that were floating out there were $10,000 per person, perhaps $50,000 per person. So at the level of $10,000 of forgiveness, what you're looking at here, that chart on the right, is 15 million people will have their debt completely erased if they're on the receiving end of that $10,000 worth of cancellation. At the $20,000 level, we jump up to have 24.2 million people who would see their balances erased to zero. And within both of those categories, I think it's also important to acknowledge the borrowers who are in default. At the $10,000 level, we're talking about nearly 5 million people who are in student loan default. Default is a condition where you have missed payments for more than 270 days. So if that $10,000 worth of relief, 15 million people will have their balances erased, including nearly 5 million who are in default and suffering some extreme consequences that come along with being in student loan default. Now, if we look at the high end, many people were talking about canceling it all or canceling $50,000 per borrower. If $50,000 per borrower had been canceled, we would have seen 36.1 million people have all of their federal student loan debt wiped out. So the number that we've seen today come from the Biden administration, that maximum is $20,000. And of course, it's subject to condition, but you can, conditions plural, but you can see that even at the $10,000 level, we're talking about relief for a massive portion of the people that currently owe federal student loans. So about the Biden administration's student loan debt relief plan, the president delivered remarks this afternoon, and I just wanted to highlight some of the takeaways that came from those remarks. And you can find the details of the announcement regarding today's plan at studentaid.gov/debt relief. The first takeaway, of course, is that the payment pause that has been in effect since March of 2020 has been extended until December 31st of 2022. We expect that this will be the final extension, but again, during that time, no payments will be required and no interest will accrue. Now, the second takeaway is where everyone is focused, and that is targeted debt relief of, and I put this in quotes because I pulled this language straight from the Office of Federal Student Aid, This is targeted debt relief of up to $20,000 in debt cancellation to Pell Grant recipients with loans that are held by the Department of Education, and up to $10,000 in debt cancellation to non-Pell Grant recipients. Borrowers are eligible for this relief if their individual income is less than $125,000 or $250,000 for households. So again, the ceiling that we're seeing through this particular relief program is $20,000, and that would be made available to Pell Grant recipients. There hasn't been any information that I've seen so far that places conditions on when a person received a Pell Grant. So the details are forthcoming. I will keep an eye out for that, but right now there's been no dates attached to that. It's just Pell Grant recipients have a higher ceiling for the relief, up to $20,000. The other question that people have is, well, what kind of loans are affected by this, or who's affected by this? This relief includes current students and borrowers who have federally held undergraduate, graduate, and Parent Plus loans that have been fully dispersed by June 30th of 2022. So for those of you that have undergraduate student loans, graduate student loans, and Parent Plus loans that you may have taken out for your child, if you have any of those types of loans that are federal student loans, then this relief can apply to you. The other question that's come up a lot is, will this canceled amount be taxable? Right now, we've heard that at the federal level, this debt will not be treated as taxable income. What happens at the state depends on which state you reside in and file your tax in. But for now, we've heard that at least this debt that's canceled will not be treated as taxable income when you file your federal income tax return. All right, the third takeaway is definitely, there's more to this one. This one is about a proposal to create a new repayment plan that caps payments at 5% of the borrower's discretionary income. And the information that I pulled here, again, is straight from the Office of Federal Student Aid. So 4 points here. The first one is that this new proposed plan will require borrowers to pay no more than 5% of their discretionary income monthly on undergraduate student loans. Right now, some of the other income-driven plans can require a person to pay between 10 and 20% of their discretionary income. So this will reduce that percentage down to 5%. The second thing that this student loan debt relief plan would do is raise the amount of income that is considered non-discretionary income and therefore is protected from repayment. For those of you who have been paying your loans on an income-driven plan, there's a formula there that takes a look at how much you earn compared to the poverty level. And the level that's usually considered is 150% of the poverty level. So the gap between what you earn and 150% of the poverty level is evaluated to determine your discretionary income. But in my personal opinion, the poverty level has been too low for far too long. So this particular provision would change the formula so that it jumps to 225% of the poverty level. And it says that we're guaranteeing that no borrower earning under 225% of the federal poverty level will have to make a monthly payment. The third provision is for loan forgiveness on balances after 10 years of payments instead of 20 years for borrowers with loans with loan balances of $12,000 or less. The fourth provision here is to cover the borrower's unpaid monthly interest. And this one is huge. The point is so that no borrower's loan balance will grow as long as they're making their monthly payments, even when that monthly payment is zero because their income is low. There's a lot to unpack with this last bullet, so I just want to spend a little bit of time talking about income-based repayment plans. So it is possible for some people to have a monthly payment that is $0. That's because when the formula is used to calculate their discretionary income, their income is so low that perhaps they don't have any discretionary income available. So their payment is set at zero, but each of those months where $0 is paid, as long as $0 is that particular borrower's payment, those payments count toward forgiveness through income-driven repayment or even public service loan forgiveness. So it is possible that a person has a calculated monthly payment of $0 per month. Now, the flip side of having a $0 payment is that if you're not making any payments on the loan, then of course, the principal balance is going to remain unchanged because each month that goes by, you're making no payments. But the part that has caused many borrowers to see their balances soar is that not only is the principal staying the same, but your interest is accruing every month. So if you're making zero payments, you're never attacking the principal, and the interest keeps on growing and growing and growing. And in some cases, there are times when the interest capitalizes. So all of that interest that has accrued is then rolled into principal. And if you're continuing to make zero payments or very low payments, you'll never touch the principal because you won't be covering the interest that's accruing each month. So this particular provision is very important because it says they will cover the borrower's unpaid monthly interest. That will help many people escape that kind of bottomless pit of negative amortization. So this is a big change that has been suggested to the income-driven repayment plans. As many of you know, income-driven repayment plans were designed to provide borrowers with cancellation after they've made payments for 20 or 25 years, depending on which plan they were paying on. And that hasn't panned out so well. So the department is taking several steps to adjust payment counts for borrowers who have been making payments on IDR plans and also making payments toward PSLF. But this would be an additional layer of addressing that issue of negative amortization and providing a light at the end of the tunnel for people who have been paying under the income-driven repayment plans. So those are the three takeaways from today's announcement. I'm going to pause for just a moment to check social media and check the chat to see if I have any questions. All right. And bear with me for one moment. I just want to make sure that I'm getting to everyone. Okay. All right. I don't see any questions as of yet, so I'm going to move on to talk a bit about targeted relief. So the announcement from the Biden administration today covered broad relief that is meant to reach federal student loan borrowers en masse. Now I want to talk just a bit about targeted relief programs that have been around for quite some time. The one that has been the most popular, at least in my inbox, has been public service loan forgiveness, which is designed to forgive the remaining amount of federal student loan debt for borrowers who have made payments while working in public service for a minimum of 120 months. That particular program is only open to people who have worked for public service employers. So that includes the government, nonprofit 501c3 tax-exempt organizations, and certain other tax-exempt organizations that provide qualifying services to the public. This program had an abysmal acceptance rate. Maybe about 2% of people that had applied prior to the fall of 2017 had their applications approved. But since the limited PSLF waiver went into effect October 6th of 2021, we've seen more than 10 times that amount of borrowers have their applications approved. So I'm really hopeful that more people who have worked in public service will continue to apply for this program and access that benefit that they have earned. The thing about the waiver, though, is that it's time sensitive. It's called the Limited PSLF Waiver for a reason. It is set to expire October 31st of 2022. So we've got just a little bit more than 2 months to get as many people into this pipeline as possible, filling out the PSLF application and documenting their work history for public service organizations. I just want to make sure everyone's clear that the Public Service Loan Forgiveness Program, that program will still be in existence after the waiver expires on October 31st. It's just that the original rules, which happen to be much more strict and led to that 98% rejection rate, those rules are expected to go back into effect after the limited waiver expires on October 31st. And I see a question that's popped up, so I'm going to pause for just a moment to look at the Q&A, and then I'll jump back into this. The chat has been disabled. That's not good. Give me one moment. All right. If that didn't help, just please communicate with me through the Q&A, and I will make sure that the chat is not disabled for the next edition of Office Hours. Thank you for letting me know. Okay. All right. So let's move on to other forms of relief. One other form of relief that has generated quite a bit of buzz in recent weeks has been borrower defense. Borrower defense is basically an option for borrowers to apply to have their debts canceled because of some improper action on the part of their school. An example would be familiar with DeVry University. DeVry University had been found to have engaged in some practices that were not honest about job placement rates for graduates. And so borrowers who attended DeVry were able to apply for borrower defense to repayment, which would mean that if their application was approved, their debts could be canceled. Borrower defense is not an easy process. Borrower defense is not something that was really working with the previous administration, but now things have changed quite a bit. So there is a list out there of schools that have, that if a student has attended, they may have relief coming through borrower defense if they've already filed an application. If you find your school on the list, you could still file an application. It might take longer for you to find resolution. But for people who've applied, I believe the date to apply before June 22nd of 2022, there'll be more information forthcoming for you about cancellation that could be out there because you attended one of the schools that's on that list. There are also relief options for borrowers who have been classified as totally and permanently disabled. There's more relief for borrowers whose schools have closed. There's also been a temporary halt placed on the taxation of any federal student loan debt cancellation. One of the biggest drawbacks of the relief that was provided under income-driven repayment plans in the past was that for people, let's say, were making $0 payments, their balances were swelling because they were never attacking the principal and the interest kept on accruing. If they did achieve forgiveness through IDR, that debt was treated as taxable income. And for some people, they just wouldn't be able to afford the tax bill. So there has been a temporary halt placed on that taxation of federal student loan debt cancellation through IDR. With PSLF, with PSLF, any amount that's forgiven is always tax-free at the federal level. All right, let's move on and get more into PSLF. This is quite the popular subject. The question here is, my PSLF application was not accepted. The servicer said I had missing information, but I used the PSLF Help Tool. What went wrong? Well, the servicer, when they send the rejection letters out, they'll usually say there's missing information, but then there's paragraphs about the different kinds of missing information. If you use the PSLF Help Tool, that is the best way to go because it will help you minimize errors. If you don't use the PSLF Help Tool, your chances of making an error go up quite a bit. You could fill out answers to questions that don't apply to you. You might skip answering a question that does apply to you. You might not add an employment end date, or you might forget to check the box that says you're still employed. So using the PSLF Help Tool can help minimize errors in those spaces. However, what the PSLF Help Tool cannot do right now is help you make sure that the signatures on your form are appropriate. The most common errors on PSLF applications involve missing signatures, and that could be the signature of the employee who's applying for PSLF or the employer who is verifying the PSLF application for the employee. With the PSLF application, right now there's a requirement that the signature has to be hand-drawn. So the signature can be digital, but it has to be hand-drawn using your fingertip, mouse pad, stylus, or it could be an image of your hand-drawn signature. But it cannot be that someone uses, say, like the Adobe version where you can edit documents. You can't just type your name in an italicized font or a cursive font and have that be accepted. It actually has to be a hand-drawn signature. And some people aren't aware of that requirement for the application, and some people just forget. So if you, as the applicant, are getting ready to sign your application, please make sure that you use your stylus or your fingerprint or print it out on paper and give it a wet signature. And after your employer completes that form and gives it back to you, take a look at it to make sure that their signature is hand-drawn, because if it's not, your application can be rejected. I did hear that digital signature capability is in the pipeline, but it's not expected to become available through the PSLF Help Tool until next year. So until then, be on the safe side. Make sure that you have a hand-drawn signature. All right, I'm going to pause one more time just to look at Q&A. I don't see anything. All right, so let's take a look at the next question that came in. It's, should I consolidate first and then submit the PSLF application? So with the waiver, I want to dissect this question and talk about the process that's been recommended in the past, what to do now that we're approaching the deadline of October 31st, and then also dig into consolidation and what makes it necessary for some people who are interested in making the most out of this limited PSLF waiver experience. So the past PSLF servicer had recommended that any borrower who had to consolidate or wanted to consolidate process their consolidation first. So they would go on to studentaid.gov. That's the only place where you can go to complete the consolidation application for federal student loans. So you would consolidate the loans on studentaid.gov. And then after that consolidation has been dispersed, then they recommend submitting the PSLF application. This makes sense because if you had the older types of loans, FELP loans, and you submitted a PSLF application, if the servicer were to look at your loans, they would say, well, you have FELP loans, and FELP loans don't qualify for public service loan forgiveness. So your application could be rejected because you didn't have the right type of loans. Through the waiver, people with FELP loans are allowed to consolidate those loans into the direct loan program and have their past repayment history counted. So it would make sense that you consolidate the loans first so that by the time your PSLF application was reviewed, they would attach it to a direct consolidation loan because direct loans qualify for PSLF. So the recommendation was to consolidate and then to complete the PSLF application after the consolidation loan has dispersed. Even though that was the recommendation, it took a while for a lot of us to hear of that recommendation. So there were several borrowers who completed the PSLF application and the application to consolidate at the same time. Now, I can tell you from hindsight that people who did that still had their applications processed. It just seems that the qualifying payment counts that they received took a lot longer. For instance, I know someone who filled out both applications at the same time in December. They just got a count last month, and that count has not been updated to reflect the previous repayment history from those older FELP loans that went into the consolidation loan. So the process is working. It's just taking longer because the PSLF application was submitted before that direct consolidation loan had come through. Now, since we're getting closer to October 31st and a consolidation can take up to 6 weeks, I would just urge you to get all of your applications in by October 31st of 2022. I would rather you get all of your paperwork in than try to cut it close and make sure the consolidation loan is dispersed and then submit the PSLF application and suppose there's an error or something that comes up. You want to be mindful of that deadline and try to get all of your paperwork in as soon as possible. So if you feel comfortable doing it all at the same time, go for it. If you want to give it a little bit of breathing room, if you have those FELP loans or direct loans that you're consolidating, I understand that too. The important thing to remember is October 31st, 2022 is the deadline. After that date, we're expecting the older, more strict PSLF rules to go back into effect. So I definitely want you to have your application reviewed using the most lenient rules. So here's what happens. When you consolidate your loans, whether they're federal, the older FFEL loans or direct loans, or a combination of those two types of loans, the application is at studentaid.gov. There's an opportunity in that application for you to select your loan servicer. And there should be a note there that says, if you're pursuing public service loan forgiveness, select MOHELA. MOHELA is the one servicer who will be responsible for public service loan forgiveness going forward. Previously, it was a company called Fed Loan Servicing. They are exiting the business, and I think as of a couple of days ago, they transferred about 50% of their portfolio over to MOHELA. So if you're consolidating, select MOHELA. That way your consolidation loan will end up with the servicer who is responsible for the PSLF program. You'll also see a note that the initial part of the processing will go through a company called Advantage. I know that this is a lot going on, but I just want to make sure that you all understand that all of these are normal parts of the process. So your loans are going to end up with MOHELA. They'll stop by Advantage first, and that process takes approximately 45 days. As for the PSLF application, a smoother process would be to let that consolidation loan disperse first and then submit the PSLF application. But if you have to, get it all in together to make sure that it's all there by October 31st of 2022. Some things for you to keep in mind are that there's a lot going on in the general student loan space outside of public service loan forgiveness. And then within public service loan forgiveness, there's a lot going on. So the things that we've seen with the borrower experience since the waiver was implemented in October, those experiences are evolving, and they will continue to evolve because we have this new servicer that is now taking care of public service loan forgiveness, and that is MOHELA. So there's still a learning curve going on with this thing, and I will continue to report back to you all with what I'm seeing from borrowers who are in the process of applying for and receiving public service loan forgiveness. And I see I've got one thing that's come up in the Q&A, so I'm going to pause for a moment and take a look there. The question is a great question. It's who signs the PSLF waiver form for an applicant if they are retired in lieu of the employer? So if you're retired, you could go back to your employer and ask for them to sign. In many organizations, they're leaning on HR. It doesn't have to be someone from Human Resources. It could be a past supervisor. It could be anyone within that organization who could verify your employment. So when people hear the language authorized official, sometimes they think, oh, there must be one person who's been designated as the authorized official for this organization. And that's often not the case. An authorized official is just a person who's authorized to verify employment. So if I were to call your employer to evaluate you or to check your references because you were applying for a new job, it would be a similar situation. It's just that in this case, the authorized official needs to be able to verify the information that you provided on the application is true. That information includes your start date, your end date, your status, whether it was full-time or part-time, and the average number of hours that you worked per week. So any person with access to that information who could verify that that information is true is a person that can authorize your PSLF application. If you are not able to find anyone willing to verify your employment, there is an option on the application and in the PSLF Help Tool for you to check a box that says, I'm unable to find someone to certify this form, or the organization has closed or is no longer in business. I would use that as a last resort. So I would recommend reaching out to, you aren't able to get anyone to certify. You're going to have to provide additional documentation of your employment. Past W-2s are the typical, they're typically the first type of documentation that is asked for people who are not able to have someone certify the form. All right, and I've got one more question. Can you talk a little more about consolidations with regard to loan terms and how that shifts? Of course I can, and give me one moment because I'm pretty sure I have some slides for that. So here we go. With consolidation, consolidation is the process of taking one or more existing federal student loans and combining them or rolling the one existing loan into what's called a direct consolidation loan. Possible reasons to consolidate. The first one is for easier record keeping. This is becoming less of a concern, but years ago, it's quite possible that a person could have 6 or different loan servicers, several loan servicers, and that would mean that each month they'd have to make a payment to each of those loan servicers, and that could get quite confusing. So for ease of record keeping, some people would go through consolidation so that those 6 servicers would now go to one servicer, one bill, one point of contact. The other reason to consolidate is for gaining eligibility to the Public Service Loan Forgiveness Program. Some people have those older FELF loans, and to get those on track for PSLF, a person would have to consolidate those loans into the direct loan program. Now, With this particular example here, we have two loans, one for $30,000, the other for $40,000. If these two loans were consolidated through the federal government, the new direct consolidation loan would be for the same amount, $70,000. Since your question asked about the terms, the other term to consider is the interest rate. With federal student loans, consolidation doesn't lead to interest rate savings. What happens is they take the weighted average of the interest rates on the existing individual loans. So if you had interest rates that were between 5 and 6.5, and you consolidate the loans, then your consolidation loan will have a rate that's somewhere between 5 and 6.5. The exception to that is that in some cases, the department rounds up to the next 1/8 of a percentage point. So if you didn't land on one of those 1/8, they would just round you up to the next highest one. So you can expect that your interest rate will be similar, but it's not going to save you anything in terms of interest to consolidate. Now let's take a look at how consolidation plays into public service loan forgiveness. Now, prior to the waiver, if a person with FELP loans consolidated their loans, the new direct consolidation loan could get on track for public service loan forgiveness. But the reason many people decided against this consolidation was because their past repayment history would not be considered. So if you've been paying on a FELP loan for 7 years and you consolidated that FELP loan into a direct consolidation loan, you wouldn't get credit toward PSLF for any of the payments that were made on those FELP loans in the prior 7 years. You would start over with your repayment clock at 0. And for many people, that was unattractive because they thought, well, now I've got to, start to go to 120 all over again. And many said, you know what, I'm just not going to do it. I'll keep paying on these FELP loans and I won't worry about public service loan forgiveness. So with the waiver, though, you can consolidate those FELP loans into a direct consolidation loan and gain credit for those past payments toward the 120 that are necessary to achieve forgiveness through PSLF. So this has a couple of benefits. One is that, of course, you get credit for those past payments. But two is for people who have loans that have different repayment histories. So if you, let's say you had FELP loans from your undergraduate experience, and then you had direct loans from a graduate school experience. In theory, before the limited waiver, you would have to apply for PSLF twice. Once when the grad school batch reached 120 payments, and once when the undergraduate school batch reached 120 payments. With the waiver, you can take those undergraduate and graduate school loans, you can combine them together, and the new consolidation loan will be given credit for the number of payments attached to the loan with the oldest or the largest repayment history in the portfolio. So in this example that you see here, we have two loans. One is a direct loan with 50 months of qualifying employment and repayment history. We also have a FELP loan, which is older. It has 110 months of repayment and employment history. If these two loans are combined together, the new direct consolidation loan now has 110 months of repayment history. So through this waiver, that loan that had 50 months has now become 60 months closer to forgiveness. And this is why many people who have direct loans are consolidating them, because it can get all of their loans onto the same repayment clock. As far as consolidating for the waiver is concerned, you don't have to consolidate unless you have FELP loans, because FELP loans on their own are not eligible for public service loan forgiveness. But if you have direct loans and you're in a situation like this, where they have different lengths of repayment history, you don't have to consolidate them because they're direct, and direct loans qualify for PSLF. However, if you wanted to get them all on the same repayment clock, you could consolidate them. And the most recent loans in the portfolio would be brought up to the speed of the oldest loans in the portfolio. So with consolidation, it's only a necessity for people who have FELP loans, but for people who have direct loans, it may help them. The other party that this consolidation could help are people who have student loans for themselves and student loans that they took out for their child. So if you have Parent Plus loans and student loans for yourself, then this same scenario could apply. You could consolidate the Parent Plus loans with the loans you took out for yourself. I haven't met a person who's had Parent Plus loans longer than they had loans for themselves. So the loan with the longest history in the portfolio is usually the loans that the parent took out for themselves as a student. And if that's the case, once those loans are combined with the Parent Plus loans, the Parent Plus loans are then brought up to speed and can get closer to that magic number of 120. So consolidation is really, it's a necessity for FFELP borrowers, but it's something that can help people who have direct loans and also people who have direct loans for themselves, as well as Parent Plus loans that they've taken out for a student. So let's take a look at one more thing about consolidation loans. With consolidation loans, after the waiver expires, it is so important for you to get on a repayment plan that qualifies for PSLF. Because if the waiver expires as it is set to on October 31st of 2022, then you would need to be enrolled in a qualifying repayment plan for your future payments to count toward PSLF. So I just wanted to give you all a list of the qualifying repayment plans. Those qualifying repayment plans are the 10-year standard plan, income-based repayment, income contingent repayment, pay-as-you-earn, revised pay-as-you-earn, and any other plans for which the monthly payment is greater than the 10-year standard plan payment. Generally speaking, your income-driven plans are the ones that are most likely to yield a balance for forgiveness. So if you've got a ways to go, a safe bet is to go with the income-driven plans, because those are the ones that are most likely to leave you with a balance left to forgive. If you have Parent Plus loans and no other types of loans, then your options are more limited. You would need to consolidate those loans into a direct consolidation loan. And the only income-driven plan you would be able to enroll in is income contingent repayment. After that, those Parent Plus loans have been consolidated and you've enrolled in the income contingent repayment plan, then the clock would start counting monthly toward the 120 payments that you need to have your debt forgiven through public service loan forgiveness. Now, if you're a person that already has more than 120 months of repayment and employment history, then this part of it doesn't really apply to you. You just need to make sure you submit that PSLF application so that your qualifying payment count can be updated. But if you borrowed loans less than 10 years ago, or you have less than 10 years of working in public service, then you want to make sure that after the waiver has expired, you're staying on track to make sure that your future payments will count toward the 120 that are necessary to achieve public service loan forgiveness. I've got another question, so I'm going to go ahead and take that one. That question is, can you consolidate while you were in school? Consolidating while you're in school for the purposes, if it's strictly for the purposes of PSLF, I don't know that that would help you. It really depends on your individual situation, because with PSLF, the original program requires that you have both months that you have worked in public service while you were making payments or while your loans were in repayment. If you're in school, then your loans are not in repayment, so you wouldn't be gaining credit during that period. But it really depends on your personal situation. If you're a person who has gone back to school after many years and you have older loans, you might want to consolidate some of those older loans with loans that you've taken out for your current experience. But if we're thinking about PSLF, in order for your older loans to be in repayment, you would have to opt out of the in-school deferment if your loans were in the in-school deferment, if you were taking more than 6 credits or considered more than half time. So one thing I can tell you for sure is that if you go into studentaid.gov to complete the consolidation application, you'll see a list of loans that are able to be consolidated there. So if you go into studentaid.gov and click on the Manage Loans tab, you'll see the option to consolidate your student loans. Go there, take a look at the application and see which loans you are allowed to consolidate. If the loans were just dispersed, you might be able to. I don't know that it would help you though. I'd have to know more about your individual situation to say whether that could help you or not. Okay. So I don't see any other questions, so I'm going to go on back to the questions from our community. And the next one is, should I let my employer send in my PSLF paperwork? And for that question, I have a personal preference not to do that. Some employers might not give you the option, but if you have the choice, I would encourage you to get the form back from your employer and you be the one that sends it in to the PSLF servicer. The PSLF application requires your employer to do a few things. One is to verify your start date and your end date, or verify that you're still currently employed by that organization. Next is to verify the average hours that you've worked per week, your employment status, that's whether you are full-time or part-time, because PSLF requires full-time employment, and also your organization type. So you need your employer for this form. They also have to lend their signature to the form, and the signatures must be hand-drawn. They also must provide their name, their date, their title, and contact information. If the employer sends the form in for you, then you don't have the opportunity to review what they have added to the form and make sure that it's correct. Now, there's some employers who have been doing this verification for a while. They have their routine, down, and they get it done. But the sensitivity of this waiver and the limited amount of time that's left, I would strongly encourage you to get the form back from your employer before it is submitted to MOHELA, because you just want to make sure that that signature line, your own signature line, as well as the employer's signature lines, are complete. To me, it just helps you in the long run to have another set of eyes on this form before it is sent into the servicer. If your employer doesn't give you the option, then chances are they've been doing this for a while and hopefully they'll do it right. But for me, I would be most comfortable being able to review the form before it's submitted to the servicer on my behalf. All right, next question is, if I don't get PSLF before the waiver expires, what are my chances of getting it after October 31st of 2022? So what will things look like after the waiver? For this question, I wanted to share with you all just a slide that shows you a direct comparison of the rules of PSLF Basic, that's the original version, temporary expanded public service loan forgiveness, and then the limited PSLF waiver. Let's focus on PSLF and the limited waiver. For regular PSLF, there are 5 requirements that have to be met. The first one is that you have to make 120 monthly payments. The second one is that those payments have to be made on direct loans only. The third requirement is that all of those payments have to be made while the borrower is enrolled in a qualifying repayment plan. Fourth is that all of those first 3 requirements have to take place during months while the borrower is working for a qualifying employer. The 5th requirement is that the borrower still needs to be working full-time directly for a qualifying employer at the time that they submit the PSLF application and at the time that they receive forgiveness through PSLF. Now, if you look to the far right, you see the column for the waiver. You can see that 3 of those requirements are now have been stricken. We're now down to 2 requirements. The first one is that the borrower needs to have 120 periods of repayment. Notice that it doesn't say 120 monthly payments. That's because the Department of Education is not looking at actual payments that are made or have been made. They're looking to see if your loans were in a repayment status. That could be in repayment, that could be certain types of forbearances as well as deferments. The deferment part is prior to 2013, but instead of looking at actual payments and whether those payments were made on time and in full, they're looking at the status of the loans and whether those periods can be considered periods of repayment. The other qualification that remains is that those periods of repayment needed to take place while the borrower was working directly and full-time for a qualifying employer. So this, you can see, looking at how these rules stack up against each other, that the waiver is more lenient. So it should not be surprising that we've seen nearly 175,000 borrowers have their applications approved for PSLF overall, and that has grown from the 16,000 that were approved under the original rules. So the waiver is definitely making a difference. Key thing to remember is it's set to expire on October 31st of 2022. There's also another program. It's called Temporary Expanded Public Service Loan Forgiveness. TEPSLF has 4 of the 5 requirements of the original Public Service Loan Forgiveness Program. And I think it's for that reason that TEPSLF has had a similar rejection rate, hovering in the high 90th percentile. So 4 of the requirements remain. The only one that was removed is about the borrower having to be enrolled in qualifying repayment plans for the entire 120 months. There are still restrictions, especially in the last 12 months of repayment, about how much the borrower's payment needed to be for those payments to qualify for TEPSLF. So the limited PSLF waiver really is the best way for borrowers who worked in public service and owe federal student loan debt to get the maximum amount of credit applied toward meeting that magic number of 120. If you have more than the 10 years of employment history and repayment history, I encourage you to apply and make sure that if you have FELP loans, you consolidate them so that they can be considered. If you have less than 120 periods of repayment or employment history or both, the waiver can still help you because the past payments that might have been denied credit before can be approved and get you closer to the 120. You just want to make sure that after October 31st, you're enrolled in a qualifying repayment plan so that you're staying on track to get to that 120th qualifying payment as quickly as possible. For the limited waiver, we know it's a deadline. The deadline attached to it is October 31st of 2022. For temporary expanded public service loan forgiveness, that program was a bit different. It didn't come out with a hard deadline attached. It came out with an allocation of funding. And the idea is that after that funding has been exhausted, then that program will disappear. I think the number was about $700 million. I need to verify that. But because the program's rejection rate has also been so high, I think it's going to be around for a while. That funding has not been exhausted, but the limited PSLF waiver by far is your best opportunity to get the most credit toward the 120 payments that are necessary to achieve public service loan forgiveness. So I know there was a lot going on today with the announcement about broad student loan cancellation, as well as public service loan forgiveness being mentioned in President Biden's remarks. Here in Maryland, we are trying to spread the word to as many public servants as possible through a campaign called MD-TAPS, which stands for Maryland Tell a Public Servant. In particular, we want you to tell public servants about PSLF. So if you work for the government, that could be federal, state, tribal, local. If you work for tax-exempt nonprofit organizations, if you work for other tax-exempt organizations that provide qualifying services to the general public, then this program might benefit you. If you know people who work for those types of employers or have worked for those types of employers, please do tell them about this program. One important thing to remember is that the employment and repayment history that are considered for this program are only months after October 1st of 2007. That's when PSLF went into effect. So we're looking at basically 15 years for repayment history and employment history to get to that magic number of 120 months that it takes to have your remaining debt cleared tax-free. I know there are a lot of rules to this. There are applications for this, but I do believe that the potential benefit is worth exploring. So please do make sure that you take advantage of the waiver. Submit all of your paperwork by October 31st, and please tell the people in your network about this opportunity. We've created a resource page at mccfw.org/MDTAPS to provide more information about PSLF and the limited waiver. So please do stop by there, share the content. We've got templates out there for you to share this information with the borrowers in your circle as well. And I'm going to go back to the questions, but I just wanted to thank you all for joining me tonight for office hours. It's really important that we provide this resource to borrowers, especially borrowers in Maryland, so that we can get everyone who's eligible into the pipeline for loan forgiveness, but also help people see that there is the possibility for them to manage their student loan debt and also achieve financial success after repayment. So thank you. The next question we have here is, what is the best PSLF waiver application form to fill out for a teacher who is not employed at a Title I school? Okay, great question. So the Title I school has significance because there's another program called Teacher Loan Forgiveness that offers a limited amount of forgiveness, either $5,000 or $17,500, but it's specifically for school personnel who work in Title I schools or certain types of educational service agencies. So the PSLF application is separate from Teacher Loan Forgiveness, and PSLF has a broader definition of public service. With Teacher Loan Forgiveness, it's very specific about school personnel working in certain types of schools. With Public Service Loan Forgiveness, it's about the field of public service in general. So it could be a person who works at a school, for government, could be a higher education institution. There's a broad realm of public service careers that apply to PSLF. So I would recommend applying for PSLF because PSLF forgives the remaining balance. It's not just $5,000 or $17,500. It forgives the remaining balance of your federal student loan debt after you've met that requirement of 120 months of repayment while working in public service. So the PSLF application is available at studentaid.gov/PSLF. I highly recommend you log in and use the PSLF Help Tool to complete the form. The form is actually pretty easy, but you need to have the employer identification number for your employers, current and past, everything after October 1st, 2007, when you have loans that were in repayment. You also need to have your start dates and your end dates. So once you have that information, you want to log into studentaid.gov, use the PSLF Help Tool to complete your part of the application as the borrower. After you've completed the application, you want to take it to your employer. Some people accept it digitally, some you'll need to walk it in, but you want to take the form to them, have them sign the form to verify the information that you've included, and you want to, at least I would want to, take a look at that form to make sure that everything has been completed, that the signatures are not typed signatures. Make sure all the fields are complete, and then send that application into the loan servicer. If this is your first time submitting a PSLF application, that application should go to MOHELA. That is the new servicer that's taking over the PSLF program. Now, I'm not telling people not to apply for teacher loan forgiveness. In fact, if you have applied for teacher loan forgiveness before and you've received it, during the limited waiver, you can use that same 5 years that you use to achieve teacher loan forgiveness. Those same 5 years of service can be counted toward PSLF through the waiver. Under the original version of PSLF, you couldn't have that overlap. So you'd have to do maybe teacher loan forgiveness first, and then another 10 years to achieve PSLF. But during the waiver, you can combine those programs and use the 5 years toward the teacher service counted toward the 10 that are necessary for PSLF. But PSLF, again, it has a more broad reach. It's not just about Title I schools. It's about the overall field of public service. And that means working for the government or for certain types of tax-exempt organizations. So you can get that application at studentaid.gov/PSLF. All right, I'm gonna check the Q&A one more time. All right, I don't see anything on Facebook. Oh, I have a thank you. You are welcome. And please remember that as much information as I can share, so much of this comes down to your individual circumstance, the types of loans you have in your portfolio, and your work history. So there's a lot of evaluation that has to take place for individuals before they determine which path is best. The limited PSLF waiver is just a time-sensitive opportunity that I have seen change lives. So I'm encouraging people, please do take a look at your loans to see if they're FELP or direct loans. Complete that PSLF application for every employer that you've worked for that is in the realm of public service after October 1st of 2007. Send that paperwork in by October 31st of 2022, and perhaps in a few months, I'll be able to come back to you and share your success story with our community. I've got another thank you answer. Oh, You all are so welcome. It's truly my pleasure to talk about this. And all right, we are right at 8 o'clock. So again, thank you so much for joining the Maryland Center for Collegiate Financial Wellness for this August 24th edition of Office Hours. It has indeed been an exciting day. Keep in mind that as exciting as today was, there are many more developments to come. The implementation of the initiatives you heard about today will be an ongoing process. And as I get more information about those processes and these offerings, I will certainly be sure to share them with you. In the meantime, thank you so much for joining us for Office Hours. If you have any questions, please do visit mccfw.org and you can fill out our contact form and I'll be certain to get back to you. In the meantime, take care. Bye-bye.